Welcome to The Explainer. Today, we're jumping right into a really practical, no-nonsense look at how to build the absolute best portfolio mix. We'll be figuring out exactly how to put your money to work by combining different fund types for maximum efficiency. Let's get right to it. Now, if you know you should be diversifying but feel kind of stuck on how to actually split up your money, believe me, you are not alone. It's literally the #1 dilemma for investors. You hear diversification thrown around all the time, right? But then you log into your account and the immediate question is, okay, but where exactly does the money go? Well, we're going to solve that today. Here is our roadmap to demystify asset allocation today. We'll look at the diversification dilemma, define the asset roles, compare risk and return, check out an aggressive allocation model, break down a real-life SIP strategy, and finish up with smart portfolio building. Section 1. The Diversification Dilemma. So you might be wondering, why not just dump everything into equity since it has the highest returns? Well, while equity absolutely gives you that growth, it violently fluctuates. I mean, the market goes up, the market goes down. And if your entire life savings is locked up in equity during a huge downturn, that's going to be incredibly stressful. So we really need a balanced team of assets to smooth out that financial journey. Section 2. Defining the asset roles. Let's meet your balanced team. First up, we've got equity. This is your aggressive wealth creator. Its entire job description is long-term growth. It's the part of your portfolio working overtime to beat inflation and compound your wealth over the years and decades. Honestly, it's the heavy lifter. On the flip side, debt acts as your safety net. This one is all about capital protection. When equity markets are having a meltdown, your debt funds are stepping in, providing that crucial stability and protecting your hard-earned cash. It might not give you massive, exciting thrills, but it definitely gives you peace of mind. And finally, we have hybrid funds. These actually combine the two, acting as the ultimate balancer to bring down overall volatility. Because they hold a mix of both equity and debt internally, this is the asset that smooths things out. It improves consistency, so you aren't feeling every single bump in the road. Section 3, Comparing Risk and Return. Let's see how these stack up. This comprehensive view maps it all out perfectly. Equity offers those really impressive returns of 11 to 14%, but that comes for sure with high risk. Debt offers a steady, reliable 6 to 8% with low risk. And sitting right there in the middle, that's hybrid, medium risk and moderate returns of 8 to 12%. It perfectly bridges that gap between aggressive growth and conservative stability. Section 4. The aggressive allocation model. So for the aggressive investor, someone with a long time horizon who can really stomach those market swings, the optimal allocation is a 70-20-10 split. You're heavily weighted toward growth, but you aren't completely exposed out there. You still have a 20% buffer in hybrid funds and a solid 10% foundation in debt. The really crucial point here is that a massive 70% of the portfolio is dedicated to equity. In an aggressive model, this is your primary growth engine. This is exactly what turns your monthly savings into serious, life-changing wealth over a 15 or 20-year period. Section 5, a real-life SIP strategy. Let's look at the actual math for a moderate portfolio. Okay, let's say you've got a systematic investment plan, an SIP of 20,000 rupees every single month. If you're a moderate investor aiming for a nice mix of growth and stability, you'd use a 50-30-20 plan. You just distribute the rupees directly into those buckets. Step 1, 10,000 rupees goes straight into equity. Step 2, 6,000 rupees goes to hybrid funds. And step 3, 4,000 rupees goes to debt. By doing this, you instantly dial down your overall risk, but you're still actively growing your wealth month after month. You gotta be careful to avoid some really common traps, though. Too many people go 100% equity without actually understanding their own risk tolerance. And then what happens? They panic and sell during a crash. Others play it way too safe, holding tons of debt and suffering from low growth that barely even beats inflation. A lot of folks completely ignore the balancing power of hybrid funds altogether. And the most common mistake? Forgetting to rebalance. As the markets shift, your 50-30-20 mix is naturally going to drift, so you have to realign it to keep your risk in check. Section 6, Smart Portfolio Building. I love this analogy. Think of your portfolio as a high-performance car. Equity is your engine, driving you forward. It gives you the horsepower to actually reach your financial destinations. Debt, that's the brakes, keeping you safe.
It stops you from careening off a cliff when market conditions get dangerous. And hybrid? That's your suspension. It absorbs the bumps in the road, making the entire ride so much more comfortable. You wouldn't drive a car that only had an engine and absolutely no brakes, right?
So your final takeaway is super simple. Combining these assets purposefully gives you a much smarter, better performing portfolio machine. Don't depend on just one asset to do all the work. Deliberately combine equity for growth, debt for safety, and hybrid for balance. That is the true secret to consistent, stress-free investing. As a quick reminder, this conversation is for educational purposes only. Mutual fund investments are subject to market risks, and you should definitely consult a qualified professional before making your own financial roadmap. So, looking at your own financial goals right now, are you ready to get your balance machine out on the open road? Or is your portfolio desperately due for a trip to the mechanic?